Banks are shutting down business lines of credit. Yes, it's happening again. Some small business owners are facing concerns that their lines of credit may be canceled soon due to elevated interest rates that are causing a reduction in business loans. And according to the National Small Business Association, more than half of the owners in a recent poll said that they are unable to obtain adequate financing, while another third said that terms have become less favorable to their business in just the last month. 13% of the owners said they have experienced a decrease in the account limits of their credit lines or credit cards in the last month also. These lending restrictions have created a ripple effect on small businesses' ability to maintain and grow their businesses, and that's further backed up by the latest ADP jobs data showing that jobs in financial activities, professional and business information, and manufacturing were lost in March. I was just in a meeting with National Business Capital, one of the largest alternative lenders in the country, and they told me some of their clients have received notices that their business lines of credit will be terminated in 60 to 90 days. Some small business owners who have experienced situations like these describe it as working without a safety net, and they stated that I'm doing a good job, I'm still making money, and if I can't find a new bank to take on my credit line, I could be forced into bankruptcy, and that's just unacceptable. Your business really needs access to working capital to cover those daily expenses like rent and payroll, and to manage cash flow fluctuations during slow periods and when you're waiting for customer payments to settle. So later I'll show you my trusted lenders who offer hundreds of thousands of dollars in business credit. So what are the banks really thinking before they pull your credit lines? One of the reasons why banks may pull credit from small businesses is if their bank has been acquired by a larger one. This can be a disruptive event that results in changes to policies, procedures, and even lending criteria. When a bank is acquired, it's not uncommon for the new owner to conduct a review of the accounts held by the acquired bank. This review can reveal potential risk that may have gone unnoticed before the acquisition. The new bank may choose to take a more cautious approach to lending, which could result in credit lines being reduced or even revoked. Another reason why banks may pull credit is if a review of existing accounts reveals an undesired risk. Banks regularly review the creditworthiness of their clients to ensure that they are making sound lending decisions and even managing their risk effectively. During a review, a bank may discover that a small business has taken on too much debt, has a high level of delinquent accounts, or has experienced a significant decline in revenue. Another reason is if the bank implements stricter underwriting standards. Underwriting standards are the guidelines that a bank uses to evaluate the creditworthiness of businesses and determine the terms of a loan. If a bank tightens its underwriting standards, it may be more difficult for small businesses to qualify for credit. This could be due to a variety of factors, such as changes in the economy and decreased competition. Stricter underwriting standards may also result in higher interest rates, shorter repayment terms, or lower credit limits. So to mitigate this risk, small businesses should maintain a strong credit profile, which includes having a solid track record of paying bills on time, maintaining low debt to income ratios, and keeping credit utilization low. You should also be prepared to provide additional documents like profit and loss statements and collateral to support your loan application. You should really consider other sources of credit, such as community banks, credit unions, and alternative lenders who have more flexible underwriting standards. Also, underused credit lines are another reason why banks may pull credit from a small business. Unlike a traditional loan, a credit line allows a business to borrow and repay funds as needed, up to the limit of the credit line. If a business has an underused credit line, it may be viewed as a sign of financial instability or lack of planning. A bank may choose to pull that credit to limit its risk exposure. Finally, banks may pull credit from a small business if the business is experiencing instability. This instability can be caused by a partner leaving the business, assets being sold, or a decline in revenue. If your bank becomes aware of this, it may view the business as a higher risk and may choose to pull the credit line altogether. Although credit lines provide flexibility to borrowers, they also pose risks to lenders, particularly during economic downturns like we're experiencing right now. During recession, banks tend to tighten their lending standards and reduce their lending activities. In this scenario, lines of credit can become a really good alternative for borrowers to meet their immediate funding needs. As banks become more cautious about extending term loans, businesses increase drawdowns on existing credit lines from banks. A drawdown basically means that you used a portion of your business line of credit. According to a study by the Federal Reserve, small businesses increased their credit line draws from banks during the 2008 recession when other funding sources were not available. The study also found that credit lines worked as liquidity insurance that allowed corporations to keep up with their investment plans during times of financial financial stress. Banks simply don't like business lines of credit, and they're worried about when, how, and if you will use your business line of credit, making it a big concern for them when giving out these loans. When a bank offers a business line of credit to you, there's no guarantee that you will actually use the credit line. This poses a challenge for banks in managing their balance sheets, as they must hold funds in reserve to cover any potential draws on the credit line. Banks are also concerned about the possibility of sudden and significant draws on that credit line, which can affect their liquidity and ability to lend to other borrowers. For example, if you suddenly draw on your business line of credit to cover unexpected expenses or to finance a new investment, the bank may quickly need to raise funds to cover the draw. This can be difficult and expensive for banks, particularly during times of economic uncertainty or financial market disruption, and this is part of what we saw happen to Silicon Valley Bank just a few weeks ago, right before they went under. The bank's inability to charge substantial fees for unused credit is another reason why they are often hesitant to extend business lines of credit. Unlike a term loan, where the bank can charge an upfront origination fee and predetermined interest payments over the life of the loan, a business line of credit only generates fees on the portion of credit line that you use. This can be problematic for banks, as they must invest time and resources to underwrite and approve the business line of credit. As a result, application and maintenance fees associated with that business line of credit tend to be smaller than those for the term loans. Establishing a relationship with a local credit union can be an effective strategy for you to maintain access to business funding. Credit unions are nonprofit financial institutions that are owned and operated by their members. They typically offer a range of financial products and services, including savings and checking accounts, loans and credit cards at competitive rates. One of the primary benefits of working with a credit union is that they may have more flexibility when it comes to underwriting loans and extending credit. Credit unions are often willing to work with businesses that may not meet the strict underwriting criteria of traditional banks. Additionally, credit unions are more willing to provide loans or credit lines to small businesses that are just starting out or have limited credit history. Another advantage of working with a credit union is that they typically offer lower interest rates and fees compared to traditional banks. If you want to increase your chances of getting approved for a business line of credit, plus saving money on interest payments, then you'll need to track and improve your business credit. A really good way to do that is by using NAV Business Boost, which gives you both your business and personal scores, plus it reports your payments for the Boost plan to multiple business credit bureaus. I'll leave a link to that below. Another great option is using alternative lenders. These lenders are stepping in to provide lines of credit to small businesses without requiring any collateral, also known as unsecured lending. Companies like National Business Capital, ROK Financial, ARF Financial, and Uplift Capital are making a name for themselves in this space by providing unsecured lines of credit to small businesses. They are still able to reach a wider set of borrowers than traditional banks, and as a spokesperson for one of these lenders said, business owners need more than just better access to capital. They face a variety of financing needs throughout their life cycles and need the right credit solution for each need. Whether it's buying seasonal inventory, expanding to a new location, or managing cash flow on a day-to-day basis. They offer more funding products than any other type of lender, and they work with much smaller businesses too. So if your business needs funding, I've personally spoken to these 4 lenders, and they all offer business lines of credit with just a soft credit pull to get you qualified. First is National Business Capital. They have a $250,000 line of credit available. You just need to have 1 year in business, $25,000 deposited into a business bank account monthly, and at least a 600 FICO score. They've funded over 27,000 businesses with over $2 billion. Next is ARF Financial, which is a direct lender where you can get an extremely high $1 million bankroll business line of credit. That's only if you're doing about $10 million in sales per year though. But to get in the door, you'll need at least a month in business, $220,000 in yearly revenue, and above a 551 FICO score. They have provided businesses with over $1 billion in funding too. So the next 2 are going to be the most accessible for smaller businesses with less sales revenue, and definitely check the links in the description to start your application with any of these lenders. So with ROK Financial, you'll need $60,000 in yearly revenue, 6 months in business, and a 600 FICO score to get you qualified for a $10,000 line of credit at minimum. ROK has provided a few $100 million in funding as well. Also, Uplift Capital can get you funded. All you need is a minimum of $120,000 in yearly revenue and a year in business, and a 600 FICO score, and they'll start you off with a $30,000 line of credit, and they have also funded businesses with hundreds of millions of dollars. If you still haven't earned your first $1,000 with your business, or it's still just a dream of yours, you can still get that funded with $0 in sales and no time in business. I'll walk you through how to get approved for $100,000 in business funding with business credit cards right here in the next video. Thank you for watching.